Hi, it's Dr. Marks and welcome back. We're still talking about exchange rate theory, but now we're going to turn our attention to the long run. Now remember, in the last two lessons, we've been talking about the short run and what affects exchange rates in the short run. We talked about the role of interest rates, and we also talked about the role of expectations. But now we're going to have to apply some macroeconomic theory. Let's begin. In previous units, we looked at what impacts exchange rates in the short run. Specifically, we looked at the effect of interest rates and expectations. And if you recall, these were really microeconomic stories. Of course, that made it just a little bit easier. For example, interest rates determine how attractive a country is for investment. If a country is particularly attractive, then foreign capital will flow in. But foreigners need the country's currency to be able to buy stocks and bonds. Well, think about it. If they need the country's currency, then this will increase the demand for that currency. Well, from microeconomics, we know that a demand increase means prices increase. So, as we see an increase in the demand for the currency, it's easy to determine that price of that currency will go up. And that's what drove the changes in exchange rates. It's hard to predict short-run changes in exchange rates, especially when investors are reacting to things like rumors, they hear things in the news, it's speculation. So in the short run, exchange rates might look just a little bit noisy. And so once again, I'm showing you this graph, and this is just a 1 week graph, but it shows you the exchange rate between the Japanese yen and the US dollar, and of course, we see this variability in the short run. But in the long run, patterns might emerge, and there might be long periods of increasing exchange rates, or we might see long periods of decreasing exchange rates. So you know what graph I'm going to show you next, right? We're going to look at the same exchange rate, the Japanese yen to the US dollar, and you do see these long periods of both increases and decreases. To explain long-run trends in exchange rates, we need to tell a macroeconomic story. In this unit, we're going to explore what's called the monetary approach to exchange rates. The monetary approach to exchange rates. Now, in order to use the monetary approach to exchange rates, this requires us to tell stories related to macroeconomic variables, such as money supply, price levels, and GDP. So we're going to review some of those concepts as well. But we need to also look at some tools. Law of one price. Well, we're going to need to bring that back from previous lectures. And the idea of purchasing power parity. Again, something we've introduced, but we're going to need to explore more here. We're going to need to go back to the quantitative theory of money. Now, this is something out of your macroeconomics principles class, so we'll review that as well. And this is going to take us more than one lecture for us to really be able to talk about what influences exchange rates in the long run. We're going to need to have, I think, 2 lectures. So, let's begin. Let's start with the law of one price. And we've seen this before, but let's review. The law of one price essentially says that the same commodity should sell for the same price everywhere. Let's start with a simple example of pizzas. Now, Of course, we have to assume that pizzas in your town are similar in quality, in size, etc., anything that might have you choose one over the other. So we all probably have our favorite pizza place, but let's assume away all those things that might make pizzas different and assume that pizzas are identical. Now, what if Joe's Inn sells cheese pizza for $10, but right down the road in an equally desirable location with equally as nice wait staff in an equally nice building, Cafe Maria sells the identical pizza for $13? Well, you can figure out what's going to happen here. In a world where we have complete equality of everything, quality of pizzas is the same, wait staff, building, location, at some point people are going to catch on. They'll head for Joe's instead of Maria's, right? Joe's price is $10, whereas Maria's is $13. Well, people are going to head to Joe's, but think about what that means. As demand at Joe's increases, prices are going to increase, right? So when demand for pizzas from Joe's increases, those pizzas are going to sell for higher prices. But we have exactly the opposite going on at Maria's. As demand at Maria's decreases, prices will decrease. So, what is your prediction about what's going to happen here? Eventually, the price is going to end up somewhere in the middle. And it will be the same at both locations. Both Joe's and Maria's will end up selling the identical pizzas at the identical prices. Now, what if instead we're comparing two countries? Let's use wheat as an example. But again, we need to be talking about the same quality. So we're talking about the same exact grade of wheat. So we want to assume away anything that would make you prefer one country's wheat over another country's wheat other than price. So remember, we're comparing apples to apples, I guess in this case, wheat to wheat. We also need to be talking about something that can move freely between the countries. So it's got to be easy to ship. It's got to have a long shelf life, right? We can't have it, going bad in 2 or 3 days. It can be produced in one country and then shipped to another country. So that's the kind of commodity we need to be talking about, which means we're not talking about shipping elephants to zoos around the world, and we're not talking about fresh fish that we're shipping overnight by the airlines. We've got to be talking about something that's pretty sturdy, pretty hardy with a shelf life. Now, the same conclusion holds here. Price of identical wheat should sell for the same price across the world, right? The price of the identical wheat should be the same across the world. But here's a problem. Countries use different currencies. So, if we have different currencies, we have to factor in exchange rates. But the bottom line is that if the wheat's identical, it should sell for the identical price across the world once we factor in exchange rates. So let's use the United States and Thailand. And let's assume that the exchange rate is $0.0286 per baht. So we're saying just under 3 cents a baht. Now remember, if I take the inverse of this exchange rate right here, it will tell me that that's the same as 35 baht per dollar. So it's about a little under 3 cents per baht, or 35 baht per dollar. if wheat is $100 per bushel in the United States, then using our exchange rate, we can find the equivalent price in Thailand. All right? So what we're going to do is use what we know. We've got a price of $100 per bushel in the United States. We want to use the exchange rate right here. That's going to convert dollars into baht, and that will tell us the equivalent price in Thailand. So there's nothing difficult about this. If we take $100 and set it equal to this expression, whatever we have as our exchange rate, now we can solve for the price in Thailand. So all I really have to do is rearrange this equation. When I rearrange this equation, I get this right here. So if I take the US price of $100 and I divide it by the dollar to baht exchange rate, this is going to tell me the price in Thailand. So what we've just learned is that the Thai price would be 3,496 bahts. And what we're saying is that's the equivalent to 100 US dollars. All right. Now, you could have probably done that math without me even bringing it up. Now, this calculation we did right here, $100 equals the dollar to baht exchange rate times the Thai price. Well, we can make that a little more generic so that we can apply it to other contexts. So let's go ahead and make this equation a little more generic. By making it more generic, I simply say the US price equals the exchange rate, but again, it's got to be the right one. It's the dollar to baht exchange rate multiplied by the Thai price. So do you agree that that's the same equation that I used right here? I'm just putting in generic language. Now, we can arrange this to solve for E. So if I have the US price and the Thai price, we can solve for the exchange rate that would make them equivalent, right? So I've solved for E. Notice, remember, dollars per baht, and notice what that's equal to. Do you agree that it's equal to the ratio of the prices, right? So this is really just the ratio of the prices. So the exchange rate is equal to the price ratio. The exchange rate, again, dollars per baht, equals the price ratio. But what if the price in Thailand is really 4,300 baht? Again, go back for a second. Before, using our calculation, we got that the price in Thailand should be 34.96. But what we're suggesting, let me forward ahead here, is that we observed that the price is really 4,300 baht. Okay? So instead of that equal price, what we're saying is that Thai wheat's fetching a better price than what would make it equivalent, right? So, what this means is that it would be easy for us to make profits by moving wheat from the United States to Thailand, right? Because the equivalent price is 34.96 baht. So what this is telling us is that the price in Thailand is way higher than the equivalent US price. So why don't we just take our wheat, put it in container ships, ship our wheat to Thailand and sell it there? Again, we're assuming that we're talking about a product that can be easily moved and at low cost. Of course, if shipping is going to cost us $1 gazillion, then we're not interested. We can't make more money. But what we're saying, remember, is that the equivalent US price, right? Let's write this up here. $100 wheat was equal to 34.96 baht. So we're saying, hey, wheat is fetching a much better price than that. So we're really getting a higher price in Thailand for wheat than we'd be getting in the United States. So let's put our wheat on a boat, ship it to Thailand, sell it there. Well, what would happen in this scenario? Let's think through that. It'd be the same situation as the pizza scenario. Demand for U.S. wheat would increase, right? Why would the demand for U.S. wheat increase? Because everyone wants to buy it to bring it to Thailand. So the demand for U.S. wheat would increase, bidding up the price, right? Everyone wants to buy U.S. wheat. And the supply of wheat in Thailand would increase. Why? Because we've just put our American wheat on a container ship and we've shipped it to Thailand. So when the supply of wheat in Thailand goes up, well, that's going to bid price down. So you see what's happening here. We increase demand for American wheat and that bids up the price. But when we increase the supply of wheat in Thailand, because we move the American wheat over to Thailand to sell it there to take advantage of the high price, well, that's going to bid the price down. Eventually, an equilibrium will be reached, and it's going to be somewhere in the middle. So this is exactly like the pizza scenario. People ran to Joe's because they had the lower price. Demand increased, bid up price. But we didn't see Maria selling as much. Price went down. All right, you get the idea. So we're back to this idea of law of one price. Now let's move on to this idea of purchasing power parity. We can extend the law of one price to a basket of goods. So before we were talking about just wheat, but what if we're talking about a basket of goods, a bundle of different goods? The Consumer Price Index is an example of such a basket. And I know that you remember this from your macro class. Remember, the Consumer Price Index captures goods that consumers would purchase, things like housing, transportation, food. Now, we can look at this in both an absolute sense and in a relative sense. So let's move on to that. Let's start with absolute purchasing power parity. Absolute purchasing power parity says that a bundle of goods should cost the same in the United States and in Thailand once we adjust for the exchange rate. So, right, they should cost the same once we adjust for the exchange rate. That's important. So, purchasing power parity tells us the rate at which the currency of one country would have to be converted into that of another country so that we could buy the same basket. Let's say that again. Purchasing power parity tells us the rate at which the currency of one country would have to be converted into the currency of another country so that we can buy the same basket. Here I've got a basket for Thailand and a basket for the United States. So what we're basically saying is that purchasing power parity tells us the exchange rate between the Thai baht and the dollar so that I could buy the same bundle of goods in both countries. Let's assume that the basket of goods in Thailand costs 28,000 baht, but that same basket in the United States costs $800. So in Thailand it's 2,800 baht, rather 28,000 baht, and in the United States it's $800. We can use the equation below to find the exchange rate that would have to prevail. Again, remember what we're trying to do. We're looking for an exchange rate that would allow us to buy the same bundle in both countries. Well, let's go back to the equation that we've learned. So we can use this equation to find the exchange rate that would have to prevail in order for us to buy the same bundle in the two countries. All we have to do is plug in the prices. So remember, the exchange rate simply equals the price ratio. Well, $800, the price in the US, divided by 28,000 baht gives us that exchange rate. So what we've just calculated is that the exchange rate would have to be $0.0286 per baht in order to buy the same bundle in the two different countries. All right, so that's what we just calculated. So again, it tells us that the exchange rate would have to be 0.0286 US dollars per baht, just under 3 cents, in order to buy the same basket of goods in both countries. Now, that's absolute purchasing power parity. But we have to ask, does absolute purchasing power parity really hold up? Remember, we're assuming that everything can be traded easily, right? And because everything can be traded easily, it leads us to that law of one price, right? Think back to the wheat example that I gave you, that wheat is going to go from US to Thailand, taking advantage of the higher price, but that means increased demand in US, increased supply in Thailand, and the prices will level out somewhere in between. So we're asking the question, does absolute purchasing power parity really hold up? In other words, is that exchange rate we just calculated really going to be the actual market exchange rate? And we've got to remember, we're assuming that everything can be traded easily to take advantage of the law of one price. If everything can be traded easily, then we're going to have the same prices in both countries for the same goods, right? But clearly that assumption's not going to be that realistic, right? Everything can be traded. That's not a realistic assumption. Housing and some transportation, for example, using a bus or taxi, well, that's in the basket. That can't be shipped from one country to another. So if your basket of goods and services includes housing and transportation, like getting in a bus or a taxi, well, we aren't going to have law of one price there because they can't be shipped, right? And then, of course, we have to remember there are trade barriers. And those trade barriers, like quotas and tariffs, well, they constrain how much can be shipped, and they also affect prices. So we are really moving away from this assumption that everything can be traded easily. Again, remember, that assumption that everything can be traded easily, that helped us establish the law of one price. And that helped us establish purchasing power parity, right? So we're moving a little bit away from this assumption that everything can be traded easily, which means we're moving a little bit away from this law of one price and a little bit away from this purchasing power parity. All right, so 2 examples I've given you, housing and transportation. We can't just ship them from the U.S. to Thailand. And then there's quotas and tariffs, trade barriers that either limit goods or manipulate prices. All right. Now, this type of cross-country comparison that we've just made is the basis for the well-known Big Mac Index. And the Big Mac Index you hear a lot about. If you're an economist, you see reference to it a lot. Basically, Big Macs sell in almost identical form in countries all over the world. You know, McDonald's doesn't always sell all of the same products, but they do generally sell Big Macs in most McDonald's around the world. And those Big Mac burgers are basically the same. And that gives us a frame of comparison. So the Big Mac Index calculates the purchasing power parity exchange rate on this basis, doing kind of exactly what we just did with the price ratio, right? The exchange rate equaled the price ratio. Well, that's what the Big Mac Index does. Now, let's talk about the advantages of this purchasing power parity concept. Well, when we look at purchasing parity, if we look at purchasing power parity exchange rates, they can definitely be different from the market exchange rates. So we've already kind of talked about why they may not hold up exactly. When we're looking at a capital account, or if we're looking at other financial flows, we probably want to use market exchange rate data, right? Think about it. That capital account, we did a big unit on our balance of payments. That capital account captured inflows, outflows. And so when we're thinking about financial flows, we really do want to think about market exchange rate data, not purchasing power parity. But as we've also seen, market exchange rates can be very volatile. So looking at them from day to day, we do see movement in those short-term exchange rates. As we looked at 1 week period, and we saw quite a bit of volatility when we looked at the yen per dollar and the dollar per yen. But if we look at purchasing power parity exchange rates, well, they're relatively stable over time. They're relatively stable over time. Remember, because they're a function of prices. Also, market exchange rates are only relevant for internationally traded goods. Things that are internationally traded, well, we can think about market exchange rates. But not all goods are traded, right? If you think about housing, that's not internationally traded. Now, some people might buy a house in a foreign country, but we're not trading them between countries. Haircuts, taxi rides, tickets to a sporting event, again, we're not trading them between countries. We do trade wheat and clothing and steel, oil, but we don't trade housing, haircuts, taxi rides, and tickets to soccer games. These non-traded goods are clearly less expensive in Thailand than in the United States. Now, I've been to Thailand many, many times. Maybe at this point it's a dozen. But you maybe haven't been to Thailand, but I'm sure you know, given that it's Southeast Asian, given that it's a much poorer country, they're not paying $20 for a haircut, and they're certainly not paying $200,000 for a house. So we know that these non-traded goods are less expensive in Thailand. Well, again, why would that be? Because their incomes are lower. That's one reason. Incomes are lower, right? No one's going to pay $20 for a haircut in Thailand because that could be your entire day's wages. And also we know the examples that I just gave you, well, they're labor intensive, right? Haircuts, taxi rides. Well, in a world where you're making labor intensive goods and you're in a country where wages are lower, yeah, it makes sense that these prices are going to be a lot lower. So I don't think I have to convince you that the housing prices are lower in Thailand, haircut prices are lower in Thailand, their incomes are lower, they have lower wage structures. Anyway, you get the idea. Now, what if the baskets aren't completely comparable? What if the baskets aren't comparable? Well, in rural Thailand, they're plowing with oxen. But we don't really see a whole lot of oxen in our country. And in parts of Thailand, they eat a diet that's high in insects. So bamboo worms, they eat locusts, they eat crickets. Now, how do we compare that food bundle in the United States? Because certainly not too many people here are interested in those products. So, an analysis needs to factor in these things, that the bundles are different. Otherwise, we underestimate the purchasing power of income in the developing countries. So their bundles are different and their prices are lower for non-tradable goods. So when we're estimating using purchasing power parity, well, we've got to remember to factor this in. We have to consider the purchasing power of their income, because that's going to be quite different in the developing world. So for this reason, purchasing power parity is generally regarded as a better measure of overall well-being. Purchasing power parity, remember, is going to help me know what price would the bundle be if we're buying, a similar package, taking into account that the purchasing power of income is different in the two different countries. But now we have to understand purchasing power parity, that's very difficult to determine. It's very data intensive because we've got to collect all the prices to really get a sense of the purchasing power of income. So, very challenging. However, it should be noted that there's a gap between purchasing power parity and market exchange rates. So if we look at purchasing power parity exchange rates and market exchange rates, they're not going to be identical. And not surprisingly, the gap between the purchasing power parity exchange rate and the market exchange rate, well, it's going to be bigger for developing nations than for developed nations. Well, that shouldn't surprise you either, given that the purchasing power of their income is so different. Thus, we get different conclusions when we look at purchasing power parity versus market exchange rates with respect to gross domestic product. So what I'm saying is that if we calculate gross domestic product one way and we compare it to calculating it through purchasing power parity, well, we're going to get different numbers. For example, China has a much bigger impact in the world economy when we look at GDP using purchasing power parity. So when we acknowledge that the purchasing power of their currency is different, and we've got these non-tradable goods that might be relatively much cheaper in China, well, it makes China's GDP look a lot bigger in the world economy than when we don't use purchasing power parity. Another way that economists use purchasing power parity is in a relative sense. So what we just did was talk about the absolute sense of purchasing power parity. Let's now move on to talk about purchasing power parity in the relative sense. This relates a change in a country's price level to the exchange rate. It relates a change in countries' price level to the exchange rate. We expect an inverse relationship here. So let's think through this for a second. As a country experiences inflation, right, that's tied to the price level, its currency value falls, right? Remember, inflation is capturing changes in the price level. So, as a country experiences inflation, its currency value falls. So what we're saying is that inflation leads to currency devaluation. Inflation leads to currency devaluation. The idea is that exchange rates will change to compensate for inflation differentials between countries. Now, we're going to go through this more fully, so if you're not quite with me, don't worry about it. But the idea is that exchange rates will change to compensate for the inflation differentials between countries. So by inflation differential, we mean comparing two countries, one's inflation rate to the other's inflation rate. The difference in inflation rate, well, that's the inflation differentials. All right, so let's take this a step further. Let's start by reviewing inflation. Inflation refers to a general increase in the level of prices. Economists might look at changes in the consumer price index in order to measure this, right? That would be one way we would measure the level of inflation. Now, you covered this in your macroeconomics classes. So remember, the CPI, the Consumer Price Index, tracks a basket of goods over time with the idea of seeing how the cost of the basket changes. So remember what the CPI is doing. It tracks a basket of goods in order to see how the cost of that basket changes. So if the cost of that bundle of goods goes up, then we know the price levels increased and we have inflation. It's also very easy to calculate inflation rates using the Consumer Price Index. So let's do that. To calculate inflation, we need to use the new equation that we've seen before. Now remember, that's just the silly name that I've given to it to help you remember what to put where. So the new equation, remember the new equation allows us to calculate percent change. That's all we're doing, percent change. We use the new equation to calculate percent change. And it could be the percent change of anything. It could be our incomes, our weight. We've used it earlier in this class. So percent change. Here's the equation. The percent change in X equals new minus old over old multiplied by 100%. So it doesn't matter what we're talking about. You take the new level of X minus the old level of X divided by the old level of X and then multiply it by 100%. So you see why I call it the new equation. New, old, old. So here's our new equation, all right? When looking at changes in the price level, then all I have to do is plug in for X. So let's plug in for X. Well, our inflation, which is going to be percent change in the CPI, so we're calculating the percent change in the Consumer Price Index. I simply take the new value minus the old value divided by the old value multiplied by 100%, and that's going to give us our inflation level. So again, inflation is just being calculated here as the percent change in the consumer price index. All right? So all we have to do is plug in the data for the years that we're interested in. Okay? So nothing difficult here. All right. So let's practice with a calculation. Example 1, and notice I've got the equation on the right. Somehow my subscripts got dropped, but don't worry about it. So CPI new minus CPI old divided by CPI old multiplied by 100%. All right, so we want to find the inflation rate between 2013 and 2014. Well, that means we need the CPI for these 2 years. Now, let's say the CPI data we collect is as follows. The CPI in 2013 is 232.96, and the CPI in 2014 is 236.7. Well, now all we have to do is plug into the equation. So, take a moment and calculate and see what we get for inflation rate. All right, if you need more time, pause the video. I'm going to go ahead and move on. So there's our equation. So you put the new CPI minus the old CPI over the old CPI multiplied by 100%. So make sure you have everything in the right place. Then I just clean up my equation a little bit. 3.74 is now on the top. Do the math. 0.0161 multiplied by 100% gives me, and I've rounded a little bit, 1.61. All right, so our inflation rate, 1.61%. I didn't carry through my rounding, but you see what I've done there. All right, very simple. So easy calculation in terms of calculating the inflation rate. Remember, inflation is just going to be the increase in the price level, and we're going to use this consumer price index to get it. All right, let's continue. Now, let's look at the connection between inflation and the exchange rates. So, we have an equation below, and I kept trying to program it in and type it in, and it kept distorting everything, so I've just had to grab it from online, and I apologize, it is a little bit blurry, but this is the best that I can do. So let's let S0 be the current exchange rate, in other words, the spot rate right now, and we're going to call this E0. Okay? So S0, the spot rate now, is going to be E0. And let's let S sub t be the exchange rate 1 period later. All right? So, S sub t, S sub 0. So again, S sub 0 is the exchange rate now, the spot rate now. We're going to call it E0. And ST is going to be 1 period later. All right, so we're going to clean this up just a little bit. Now, let's simplify the world and look at a period of only 1 year. So if we're only looking at a period of 1 year, let's just let t equal 1, and that means we're finding exchange rate in S1. So make sure you understand what we're saying, and that is S0 equals the spot rate now and S1 is the spot rate 1 year later. Okay, so there's nothing difficult here. Very basic equation. Okay, so let me give you a second. Now let's assume that inflation in Thailand for this period was 5%, and we're going to let Thailand be country A. And let's assume that inflation in the United States for this period was 3%, and that's going to be country B. And again, I need to identify a country A and a country B, because that will tell me which one's going on the top and which one's going on the bottom. Okay? So, inflation in Thailand is 5%, their country A. Inflation in the US is 3%, and their country B. Now, the exchange rate in this case would be baht over USD, because Thailand's on the top and the US is on the bottom. So make sure you understand that we have to make sure we're thinking about our exchange rate in the right direction, because it could be USD per baht, but remember, it's country A over country B, right? And Thailand is A and the US is B, so it's baht per dollar. All right. Now, let's also say that our original exchange rate is 33 baht per US dollar. So, what does that tell us? That tells us S0, right? Now, really, it's become very easy. All we have to do is plug into this equation. So if you were to plug into this equation, you've got everything that you need. So let's do that next. So here's our equation again. Let's plug in what we know. So think about the pieces of information I've given you. I've given you S0. I've given you inflation for country A, that's Thailand. I've given you inflation for country B. So again, all we have to do is plug it in. So S1 equals 33. Remember, that's 33 baht per $1. Our numerator is 1 plus 0.05. Remember, that's inflation for Thailand. On the denominator, we've got 1 plus 0.03. Again, that's inflation for the USA. And now it's very easy. I plugged in my exchange rate, and now I can do some very simple math. So S1, our exchange rate in year 1 year from now, 33 multiplied by multiplied by 1.05 divided by 1.03. Very simple step. Now I can clean up my math a little bit. S1 equals 33 multiplied by 1.05 0.01942. You can round a little bit. So when I do this calculation, I get S1 equals 33.65. All right, well, what does that tell me? Okay, you followed the math. What does this tell me? Remember, S1 is the exchange rate a year from now. So what we're saying is that the exchange rate 1 year from now is going to be 33.64, right? So if S0 is the exchange rate at 1 year later, it's 33.64, all right? So we've seen a change in the exchange rate. And as you saw, it was a function of the inflation rates for the two countries. So in this example, the United States had the lower rate of inflation, right? They had 3% inflation versus 5% in Thailand. And the exchange rate in our relative purchasing power parity situation went from 33 to 33.64. All right, so think about it. What just happened to the US dollar? What happened to the US dollar? Because remember, this is 33 per US dollar, right? And it's now become 33.64 per US dollar. All right. Do you agree that the dollar is buying more baht than before? Not a lot, just a little bit more. But hopefully you agree that the US dollar has appreciated. Now, this seems like a pretty intuitive long-run prediction, right? So think about what we're claiming. The United States has lower inflation, and they see currency appreciation. Thailand has higher inflation, and they see currency depreciation. So, and again, remember we're talking about a relative sense. So we're looking at relative inflation. So we just said the United States has lower inflation and it sees currency appreciation. Thailand had higher inflation and it sees currency depreciation. Well, again, that makes sense, right? That's intuitive. Many researchers have asked whether the relationship just discussed holds up. Is the change in the exchange rate related to the ratio of inflation rates, right? Because that's what we're claiming, that the exchange rate is related to the ratio of the inflation rates, right? That's the claim here. And we've really just illustrated that. So some researchers have asked, hey, does this relationship really hold? Theoretically, we see it, but does it really hold in the real world? If so, we should see the US dollar appreciating when we have lower inflation than other foreign countries, right? So let's say that again. If this holds, we should see the US dollar appreciating when our country has lower inflation than other countries, right? So, we should see the US dollar depreciating when we have higher inflation than foreign countries, right? So it really depends the value of our currency. We're asking, is it really driven by if we have lower or higher inflation than other countries? Well, let's see what the data tells us. All right, so here's an interesting graph, and let's just make sure we understand what this is telling us. Now, this shows us the relationship between the yen and the US dollar. So we're just looking at the yen versus the US dollar. In red, those red bars, they capture the difference in inflation between the two countries. So that's capturing the inflation difference between the US and Japan. But it's calculating it, be very clear, it's calculating it as the US inflation minus Japanese inflation. So think about what that means. What if the number is positive? If it's positive, that means our inflation is higher in the US than what they have in Japan. And if the number's negative, then it means Japan has higher inflation. So once again, what am I talking about? I'm talking about these red bars right here. And when they're positive, the US has higher inflation. But over here, when they're negative, then Japan has higher inflation. Because, as I said, we're calculating it as US minus Japan. All right. The blue line captures the appreciation or depreciation in the US dollar. So we've got two things going on the same graph. The blue line is telling us about currency appreciation or depreciation, and the red is telling us about the differential in the inflation rates. Okay. Now, we see that when the inflation differential is positive, right, the red bars, when they're positive, then the yen to US dollar exchange rate is actually lower, right? So this means that the value of the US dollar has fallen. It buys less yen. And that's consistent with theory. So when US inflation is higher than Japanese inflation, we should see the US dollar depreciate. Well, let's see if our graph is showing us that. Well, let's take a look right here. So the red bars are negative, right? So this means with the red bars being negative, that inflation in the United States is lower than Japan. So if the United States has lower inflation than Japan, well, what does theory say? What should be happening to currency? Should our currency be appreciating or depreciating relative to Japan? So lower inflation in the US, then we know what? We should see appreciation of the US dollar against the yen. And that's kind of what we're seeing here. So this is pretty cool way of presenting it. Of course, we could look on the other end as well, right? And if I look at that end of the graph, we see that the United States has the higher inflation compared to Japan, and what do we see? We see depreciation of the currency. So the theory appears to hold up here. Let's look at it another way. So this right here is another way of looking at the same theory. We need to start by looking at the axes. Remember, when you're looking at economic data and presented graphically, you always need to look at what's on the axis. So here we've got the inflation differential, and this is not just for one country. It kind of lumps together a bunch of countries. So here's the inflation differential, and this is percent per year relative to the U.S., okay? Relative to the U.S. And then we see on the vertical axis the rate of depreciation. The rate of depreciation. So, make sure you understand what we're saying. As we move in this direction, we're saying U.S. has more inflation than other countries. So we move out to the right, U.S. has more inflation than other countries. And as we move vertically, we have more depreciation of currency. Okay. So, what do we see? We see the same kind of relationship. We see this positive relationship going on. Again, we fit a line there. So, I might be reading one of these axes wrong, but basically, the directions are right. So, it might be inversed. We see that it moves in the same direction, right? When the U.S. has higher relative inflation, or maybe it's the other countries that have higher relative inflation, we see more currency depreciation. So again, it's a little bit unclear on which direction they're going, but what we're seeing is having higher inflation leads to more depreciation of currency. I'm just not sure if they're literally looking from the U.S. perspective or the foreign country's perspective, but it doesn't really matter because the relationship holds either way. So again, this is a pretty cool graph. All right, so in this unit, we looked at the determination of exchange rates based on the theory of purchasing power parity. And there's two ways of looking at this. We have absolute and we have relative purchasing power parity. When looking at absolute purchasing power parity, we see that exchange rates are related to the ratio of price levels between the two countries of interest, right? I gave you, in fact, an equation that simply said exchange rates for purchasing power parity in an absolute sense is simply the ratio of the prices. When looking at relative purchasing power parity, we see that exchange rates are related to differentials in inflation between the two countries. So again, make sure you're following this because this is an important point. We looked at absolute purchasing power parity and we said exchange rates are related to the ratio of the price levels. When we looked at relative purchasing power parity, we said that the exchange rates are related to the differentials in inflation between the two countries. So absolute, we had one equation. For relative purchasing power parity, we had a second equation. Economists suggest that the predictive power of purchasing power parity is really most evident in the long run. In other words, it's most useful in terms of its predictive power when we look at what's going on in terms of exchange rates in the long run. Unfortunately, it's not that helpful in predicting short-run exchange rates. So remember, this unit focused on the idea of long-run exchange rates, whereas our previous units were looking at short-run exchange rates. So we have one more unit to go. Again, continuing to look at what affects long-run exchange rates. If you have any questions, let me know, and have a fantastic day.